Hey, everybody, welcome to the show. So, I've got a question for you. What if the way that you've structured your business to save taxes or protect your assets is actually making it harder for you to get funded to grow or build wealth for tomorrow? So, I think as business owners, we find ourselves thinking a lot about entity structure, taxes, business credit, funding, asset protection, all as separate decisions. But the reality is that these pieces are very deeply connected, and the decisions that we make early on either create opportunities for us later or can even limit them. So, today we're going to talk about how to build a business structure that protects what we're building, supports our growth, improves our ability to access capital, and helps turn our business success into lasting wealth. Joining us today is Tom Nagar, founder of US Corporate Solutions, and he's bringing more than 2 decades of experience helping entrepreneurs just like us structure, grow, and protect businesses. He's guiding business owners and investors across the country through the complexities of entity structure, business credit, tax strategy, and asset protection. Tom, welcome to the show. We're so excited to have you here today.
So excited to be here. Thanks for having me on.
So there's a lot here that we need to be thinking about, as business owners. And I think it's complicated and it's complex. So after, 2 decades of helping us navigate this space, what do you see us as business owners commonly get wrong when we're setting up the foundation for a company?
I think the first thing that we get wrong is not understanding that a foundation even needs to be set up for the business, right? I think as business owners, entrepreneurs, real estate investors, we're really good in the everyday job of being a business owner, right? The marketing part of it, the strategic partnerships that we get into, but we generally don't focus on the foundation of the business. And when I say foundation, I mean the structuring of the business, how we want our business to get taxed, right? And so I think the majority amount of the people that we talk to, business owners, I think it's just a lack of understanding that there has to be or should be a foundation set up at the time of thinking about the business and how we want this business to be structured should just be part of it.
So, can you give us an example of a company, no names, of course, that's come to you where, they felt like what they were thinking about was foundationally complete, and yet you had to step in and say, but maybe we should be considering these other factors over here, just so we kind of have a visual for what does a really good, complete foundation look like?
I'll give you a couple different answers for that. So a lot of the times, the majority amount of the times we talk to individuals and business owners, and sole proprietors, for people that don't necessarily have any sort of business structuring behind them. They're first-time business owners or even second or third-time business owners, but they're used to or they set themselves up as a sole proprietorship, which is the easiest way of doing business, right? I decide to go into business. I want to be a mechanic. I want to open up a school. I want to get into affiliate marketing, whatever businesses that I want to get into, real estate. The easiest way to do that is just to start the business. And so the majority amount of the people that we talk to are people in that position that don't have an entity currently, right? So we have to educate them on what an entity is and what an LLC is and why it's valuable for them to set up some sort of fundamentals and foundation for their business that they can grow on top of and they can expand and they can limit their liability and have better tax consequences and not, give up a majority amount of their profits to the IRS, right? And so that's one type of client that we deal with. The other type of client that we deal with quite often are individuals that have businesses, went so far as incorporating their business, right? They got educated to the point where somebody during the course of them having their business, whether it's their CPA or their friend or their colleague or a business partner, said, hey, listen, I think it's a great idea for us to go ahead and incorporate. I heard great things about this. Let's go ahead up and set up our LLC. And so what happens a lot of times is that people go online, they look for an incorporator or provider. We talked about this yesterday a little bit, Krista. They go to, companies like LegalZoom and they type in some of their information, right? It's all online. So, where do you live? What do you do? And then it gives them some sort of solution. Hey, you should set up your LLC in your home state. You should do X, Y, and Z. And then they pay a couple $100 and it's done. And after a couple weeks, they get some papers in the mail. And then now they think that they have an LLC. that's structured correctly, that's taxed correctly. And so that's the other type of client that we talk to. And for those type of clients that set up their entities through companies like LegalZoom, we end up unraveling a lot of the things that are done incorrectly, right? So I think one of the biggest hurdles that we talk to clients about, and we want to make sure that they understand, is that their entity itself, when you set up a corporation, when you set up an LLC, that LLC, that corporation, regardless of where you live, regardless of where the business operations operate out of, can be set up in any state that you want to. So I live in Nevada. My business is in Nevada, but if I wanted to, if it would make sense for me, I can actually incorporate my business out of Wyoming, right? Or out of Florida or out of any other state, right? Doesn't make it more complicated. But what it does do is it gives you the opportunity to go to states that offer better advantages to business owners, that are better business friendly, that might have better asset protection laws, better privacy laws. So I think one of the biggest hurdles that we come across is explaining to people, hey, listen, you might have a business and you might have real estate in California or in Arizona, but there's other ways and there's other states that would probably be more beneficial for you to incorporate your business in. Um, and as an example, most of the entities that we set up, Krista, and we talked about this again yesterday a little bit as well, is out of Wyoming. And the reason that we do that, again, regardless of where individuals live, regardless of where their business operations operate out of, the majority amount of the companies that we set up are based out of Wyoming. And the reason why is it's simple. Wyoming has just preferred laws that are advantageous to us as business owners, as real estate investors. A lot of it has to do with privacy, right? In Wyoming, I can't find out who owners are of businesses, which is very, very valuable to us, especially in today's age where you can find out anything about anybody. And one of the biggest triggers with lawsuits and frivolous lawsuits is for me to find out what you have. And if I can do a simple search and find out that you have LLCs and that you control LLCs and those LLCs have, real estate assets inside of them, it's a lot easier for me to take on a case pro bono just because I know that there might be some sort of reward at the end, right? And so privacy offers a tremendous amount of asset protection. And so if you look at asset protection kind of as an onion, as layers, one of the layers of asset protection is privacy. And so Wyoming does a phenomenal job in providing a great amount of privacy to business owners. Um, there are other laws that Wyoming has that's again very advantageous to again somebody that wants to get into business, that deals with the public, that does affiliate marketing, does real estate for just the assets. So besides the privacy, it's almost impossible outside of committing fraud, outside of doing something intentional in terms of the fraud space. It's basically impossible to do something called the piercing of the corporate veil in the state of Wyoming. And that's the biggest thing that we have as business owners. And when we set up the LLC, of that happening, of the piercing of the corporate veil, right? And I think one of the biggest questions that we get from people is, okay, Tom, that sounds great, the whole Wyoming thing, but I don't live in Wyoming. I don't do business in Wyoming. Is it legal for me to do that, right? Is it legal for me just to set up? So the answer is yes. Just like we can cross borders and do business anywhere, I can do business in Wyoming, I can do business in Florida tomorrow, I can do business in any state that I want to. I can move to any state that I want to. I can buy real estate in every state that I want to. The same thing goes for your corporations and your LLCs. You can decide exactly what states you want to do that with. And again, I would say that the best state in the country right now and has been for the last several years is Wyoming. Wyoming is the preferred jurisdiction for a lot of privately held companies to set up their businesses. Delaware, I'm sure a lot of people here probably heard about Delaware. So if you look at credit card companies, you look at banks, you look at big financial institution, Fortune 500 companies, a lot of those are based out of Delaware because, again, they have specific laws that protect publicly traded companies in that space, and the directors. So, Microsoft is not physically located in Delaware, but they have their charter and their corporation based out of Delaware. Same thing for, Boeing and a bunch of other companies that are part of that Fortune 500 group. Um, so going back to the hurdles, that's one of the biggest hurdles that we come across is that one, people are setting up their LLCs in the incorrect state, right? The other thing that people don't understand is if I'm a real estate investor and I choose to go and buy a piece of real estate, let's give California as an example. California is probably one of the most litigious states out there with the most amount of lawsuits, with kind of the worst business friendly attributes of any other state. So let's give them as an example. But again, this is the majority amount of the states. But California, as an example, is probably the worst. There are neighbors, great state to visit, but again, very bad in terms of the business aspect. So in California, let's say that I do set up my LLC in California, and I'm a real estate investor, and it's just myself or me, my significant other listed on the LLC, which is the majority amount of real estate investors. They're individuals, or it could be, a couple listed on the LLC that are doing the business together. In the state of California, LLCs, single member LLCs, can be disregarded not only for tax purposes, but can be disregarded for asset protection. Means what that means in layman's terms is that if somebody sues your LLC in California and it's a single member LLC, they would look at that single member LLC just like they would look at a sole proprietor, which means that you and the business are one and the same. There really isn't that barrier that protects you. That barrier is called, your corporate veil, which is the it's the mechanism, right? That corporate veil is basically the mechanism that separates you and the business from one another. And if I'm able to pierce that mechanism, if I'm able to pierce that veil, there's really no use for the LLC because now you're suing personally as an individual and getting a hold of my current assets, potentially coming after my future assets, right? So in the state of California, regardless of if you set up the LLC correctly and you got the tax ID number correctly and you did your minutes and your meetings and all the other things that have to come along with the LLC, let's say it's perfect. Even that, when you have a single member LLC in California, it's very easy to pierce that corporate veil and actually come after you personally, right? So that's Chris, that's all on the asset protection side of things. So those are the things that we see that a lot of clients that we talk to um, struggle with, right? They might think that they have an LLC, but they're doing it incorrectly, or they don't have an LLC, and we lead them down the path of, hey, listen, these are the advantages, these are the pitfalls that you need to look out for as a business owner. That's on the liability side. That's on the asset protection side of it. The other side of it, which is the important part as a business owner, is the financial part of things. The LLC, when you set up an LLC, that's just the beginning of figuring out exactly how the structure needs to happen. The other part of an LLC is how do I tax this thing? When you set up an LLC, it's automatically taxed as a disregarded entity, which we generally don't want. The other ways that you can tax an LLC is something called an S election, a C election, a partnership, right? So how do you navigate through those? They all have their advantages, they all have their disadvantages based on the type of income that you're making, right? As a real estate investor, we have something called passive income and active income, depending on whether we're holding properties or flipping properties, whether we're contracting properties, and whether we have commercial properties. Really, there's a lot of variation in that. So when you go to companies like LegalZoom, nobody knows that information. Nobody's asking you these questions in order to build a correct foundation for you, right? There's a difference of an LLC and the difference in structuring of whether you come to us and say, hey, listen, my right now what I'm doing is I'm buying real estate. I'm buying and holding rental properties. My long-term goal is to, in the next 10 or 20 years, I want to own a certain amount of properties. Maybe I want to get into commercial. There's a big difference between that client and another client that says, hey, listen, I'm getting into real estate, but my goal is to buy and sell properties within a given year. What I want to do is I want to rehab some properties, I want to sell them, I want to generate some income. Two of those might be LLC category, but their tax strategy and their tax elections are going to be completely different. And so a lot of the times what we see is that people have LLCs, but they're taxed incorrectly. And they let go of their LLCs after a year or two. They just dissolve them, they let them go. And the number one answer that we get from people of why they haven't utilized their LLC or why they're closing it down is because they didn't know how to utilize it. It wasn't, they didn't feel that it was giving them any sort of advantage, right? Um, and because it was done incorrectly. And so those are, I think, the struggles that we have or that the clients have sometimes by getting this new information that when we go over it in the correct way, right? And the correct way is really analyzing the individual client's needs, what they have going on, what it is that they're looking to accomplish, what their short-term and long-term goals are, whether they have partners, you know, all that plays a role on how that structure needs to be done and how that foundation needs to be set up. So that's the fundamentals.
So there is a lot of points of consideration there, even just within the entity, type itself. Yes, you could do an LLC, or you could do an S corp, or you could do a C corp, and then within the LLC, what I think people fail to understand is an LLC might provide you asset protection, but it gives you no tax advantage until you make that election in terms of, as you were talking about, how do you want it taxed. And I think there might be a lot of confusion around, well, what should I even be thinking about when I go to set my entity up in the first place? LLCs, I think, are popular because they're quick and easy. And I think from a corporation standpoint, that word can be scary to business owners. Well, what about compliance? What about paperwork and meetings and all of these things that, I have to keep track of? But is there a very quick kind of short rule of thumb for when we should be considering, instead of an LLC, an S corp, or even a C corp, and why? So what are the leading indicators of, hey, you're ready for this, instead of being a sole prop or just somebody who's got an LLC that has no designation on it?
Okay, so I'm going to give a broad answer to people that are listening. The best way to go about this is have a team behind you, whether you have somebody like us, a company like us that directs you and kind of, talks to you once a quarter, once every 6 months, once a year to kind of figure out where you are, to continually guide you through the process. Because the one thing with structure, it does evolve. You might start with one type of structure today, and it might involve and evolve into a different structure 6 months down the road or 10 years down the road. So it's always important to really have a team behind you that's looking at the things that you don't see, right? You're as a business owner, as an entrepreneur, we're focused on the business, right? We can't see everything as a business owner. It's impossible for us to see everything. And so that's why it's great to have a team that can see everything. So look, in today's age, here's what I can tell you. What makes us different in terms of our personal approach is that most of the industry today, when it comes to incorporation and setting up LLCs, it became more automated. And so with us, what the difference is that we still do, live on one consultations, and we still try to figure out what you have going on and what your future plans are and what your goals are and what kind of business that you're going into. And based on that, we will give you recommendations. Do you need to start off as an S? Do you need to start off as a C? Do you need to start off as a partnership? Do you have anything else going on? Do you have any other businesses? Do you have W-2 income? Right? The transition, so just to make it clear, an LLC and an S election or C election isn't a different type of an LLC. So what's great about an LLC is that it can get taxed in a variety of different ways. Corporations, so let's start with this to make it easier. Corporations and LLCs are on a state level. If I want to set up a corporation or I want to set up an LLC, I go to a Secretary of State and I set up those two entities, right? So it's a state issue. When it comes to taxes, that's a federal issue. S corp, C corp, partnership, which is a 1065 election, those are all IRS issues. Those are federal issues. So once you set up your LLC on a federal level, you now have to tell the government how exactly you want your LLC to get taxed. Now, when you set up an LLC initially, if it's only an individual, the IRS automatically puts you in a category called a disregarded entity, where you're basically paying taxes as a sole proprietor. When we set up your LLC, we make the determination at the time of setting up the LLC of whether we want the LLC to be taxed as an S, right? So it's not a different type of entity. It's just the way that the LLC can get taxed. So an LLC can get taxed as a S corporation. The LLC can get taxed as a C corporation. It can be taxed as something called a partnership as a 1065, and it can be taxed as a disregarded entity. Corporations can be taxed only two ways. They can be taxed as an S corp or a C corp. So it's not a different type of entity. It's not a different. You don't. The IRS also frowns upon you going back and forth between an S and a C. So you really can't go back and forth. So we really need to make sure that, again, when we set up the foundation, that it's set up correctly, right? It's just like if you're building a house and you're in the blueprint print phase of your house, and all of a sudden, once you build a first and second floor, you decided that you want, your pipes running underneath the foundation. It's very hard to do. You're going to have to demolish everything. So that's why it's important to have these conversations prior to start making dollar one, right? So I think when you're a successful business owner, when you've been in the business space for a long time and you've had several businesses, and you're a real estate investor and you've done and bought properties in the past, you know that before you buy a property, that it's a great idea for you to go set up your LLC. Today I know that if I want to set up a business, no matter what it is, before it makes a dollar, I go set up my LLC because there are reasons behind that, vital reasons of why I want the LLC way prior than me opening up my doors, getting clients, making money. That's the foundation, right? So sometimes we have to unravel what people have going on. Sometimes, again, a lot of the times people come to us, they already have their LLCs, they already have a corporation set up. Sometimes it's set up in the incorrect state. Sometimes their tax selection is done incorrectly. So for those individuals, we have to change things. So to give you a number of when you want to change from an S to a C, it's very hard because it depends on the individual, Krista, what they're looking to accomplish, what other income they might have, if they have partners in the business, if they need the income to come to them personally. There's a lot of variables to determine on the tax selection and when those changes need to happen.
I think there's something we could potentially give everybody listening that also could help. And again, we should be thinking about all of these parts together as the whole. So I would think when we're calling in to talk to you, that we also need to be thinking about wealth building and estate planning, because there's going to be a point at which one entity really is not going to achieve everything that we need on both our business side and our personal side, because we want to be protecting all the assets we have. We start by thinking about the business assets first, but it's going to transition. So a use case that I've seen happen to quite a few colleagues that I know is, and we'll take real estate as an example, but really it could be anybody who's got an S corp and they've got a lot of expenses, and the intent is they want to write that off because they want to maximize their tax advantage. But then when they go to actually apply to get a home loan and they say, all right, what's your source of income? The business itself has a lot of revenue, right? That's passing through and directly onto your personal tax return. But then they're getting in there and going, but you write everything off, you don't make any money. And so we saw a big shift in the real estate side where we saw people moving from S to C Corp, which I think everyone's biggest complaint there is, oh, double taxation. Yes, but kind of not really, right? So that the business actually had its own revenue. You're being paid a salary, much the same as you are with an S, but it's not passing through to your personal return. So the business kind of stands on its own, where you're able to say, yep, I'm an employee for this company. Therefore, anything you're qualifying for on the personal side of the fence becomes a lot easier. So would you say that that's becoming part of the conversation that you're having as well? Like, what are you trying to do in your personal life that, having an S or a pass-through entity might create a barrier if you're really looking to maximize your taxes?
Correct. So I'll give you an example so sometimes we do use the C corps in combinations with C corps and LLCs, and so sometimes that's appropriate. I'll give you an example on some of the things that you mentioned. If I'm a real estate investor and depending on the type of property that I have. So when we buy and sell real estate within a given year, so if I buy and sell real estate, I bought a property for $100, I sold it for $200 within that 12-month period, I have something called short-term capital gains, which is very high. As an individual, what happens with short-term capital gains is that all those gains, right? I don't have an LLC, bought a property, sold a property. That $200 profit comes to me personally as an individual. What ends up happening to that $200 that I just made profit, I end up paying every single tax on that money. I pay my state taxes, I pay ordinary taxes, I pay every tax on it on the highest level. I pay taxes on it based on what my current tax rate is, right? So that's really, really bad. So the reason that we use, as an example, S corporations when we're buying and selling properties is because S corporations eliminate all the short-term capital gains. S corporations don't recognize short-term capital gains. So if I talk to an individual and let's say that they're currently making the business makes $100,000 a year and or $200,000 a year, and they say, "Hey Tom, listen, this is our only source of revenue. We don't have any other businesses. We don't have any W-2 income. All the revenue comes from my business. And I need all that revenue to pay for my lifestyle, to pay for my mortgage, to pay for my cars, to pay for my trips, to pay for my kids' education. I need that income." Well, if you need the income, and we know that you need the income, and let's say that business generates $200,000 gross, and after expenses, you expense the company out to the max as much as your CPA would allow you to do, and you paid your home-based office and your a lot of the education and your trip, whatever you could came out of the company. Now, what you have left over in that company is you have $100,000 left over. If you do the calculation, it's much better for that $100,000 to come to you through the S corporation than it would to come through a C corporation. And the calculation is very, very simple. If you made $100,000 in a C corp, you're paying 22.5% on a federal level, plus a state level if you have state taxes. That's on a corporate level, has nothing to do personally. Now we're talking about profit. This is after expenses, you have $100,000 sitting in there. You have to pay 22.5% on that 100K. Now you want to take that money personally, you're not going to pay taxes on that money as well, right? So there is a little bit of a double taxation going there. Now there's times when that C corp is available, but I'm giving you an example of the everyday person that's just making $100,000 or $200,000 a year. Now, if we do it through the S corp, you would take generally, we would do an 80-20 split, meaning 20% of that 100K would come to you as a W-2, where you would pay, your FICA, Medicare, Social Security tax, all that good stuff, which is about 15.3%. And then you would pay all those taxes on it. The rest of that money, Krista, would come to you as a K-1 distribution. Now, on that K-1 distribution, there isn't any self-employment tax. You're able to eliminate 15.3% of every dollar that comes to you, which is a massive amount, right? 15% of that money you can reinvest in your company, whatever it is that you want to do. So now let's talk about the C corp. A lot of the times we set up C corps, and what they become generally is a C corps become management companies. So if I have an LLC and now I have a lot of properties and I'm generating more income than I need to live on, that's the problem. That's when we come up into tax strategies. So Krista comes to me and says, "Hey, listen, Tom, I'm making $200,000 a year, same scenario, but I also have an amazing W-2 job that I make enough money to sustain my lifestyle and pay my mortgages and pay my cars and my kids' education. But now I have this business that's generating all this income that I don't need. I don't want to take the income and pay my state taxes and pay all these taxes on because I'm not even utilizing this money. What can we do?" That's where the C corps come into place because they retain the earnings. They're not passed through. And the C corps now have great things that you can do within the C corp to eliminate even more taxes, right? Set up defined benefit plans, set up insurance plans, set up college education plans. Um, but that has to do with revenue that you don't need to live on. And so What's that number? It depends on the individual. That's why, again, I always go back to there has to be you have to have a conversation with somebody that's knowledgeable about your situation and really wants to dive into what you have going on to give you. So it's it's very hard to give that answer because there isn't a threshold. It depends on the individual. The other thing that you talked about, and we talked about yesterday a little bit, is multiple LLCs, multiple corporations for doing different things. That's very, very valuable because what we want to do a lot of times, again, especially in real estate, is we want to limit our liability. We don't want all our eggs in one basket. I'll give you an example without mentioning any names or any companies or anything like that. Not too long ago, um, there was I live in Las Vegas. Our company is based out of Las Vegas. Um, we knew a company very successful here in Las Vegas. They had a lot of different restaurants here in Vegas. And unfortunately, one of their one of their restaurants, for a variety of different reasons, had to shut down and had to bankrupt. Now, what happened is all of their restaurants were under one company. So this one bad egg spoiled everything that they had, and they had to let go of all of their assets and all their company assets, right? Now, if they would have segregated their liabilities into different LLCs, they wouldn't have had that issue because they could have just bankrupt that one LLC, closed that one LLC, and continued on with the rest of their businesses. The other times that these things work, I'll give you an example of my personal self. I'm in the real estate space as well. I've been investing for a long time. One of our holdings are we have some motels, right? In our motels, we have different LLCs, one for the ownership of the property and one for the management of the property, right? Those are two separate entities. They work together. My management company leases the real estate from the real estate holding company, right? Again, we want to shelter my liability. So, God forbid, if there's an event that something happened in my day-to-day operations of my motel, we want to make sure they're not suing the entity that actually owns the land in the actual motel, right? So again, just if we can, limiting our liability as much as possible. But again, that depends. So a lot of the times when we go and do stage work and we talk to real estate investors, and one of I think the biggest questions that we get is, so how many LLCs do I need for the real estate that I have? Well, I don't know. I have 10 properties. How many LLCs do I need? You'll be surprised. A lot of people will give you an answer to that right away. They'll say oh, you need 10 LLCs. You need 5 LLCs. But let me explain to you how that's inaccurate and how I need that information in order to give you that answer. If Krista comes to me and says, Tom, I have 10 properties, and I ask her, okay, tell me about your properties, and you say, I have 10 rentals. Each one of those rentals is worth $100,000 and they're completely encumbered. I owe mortgages. Each one of them has a mortgage of about 90,000. So in total, you only have $100,000 in equity, right? So if somebody sues you, they're not going to sue you for the liability. Nobody's going to take away these properties. They're completely encumbered. But now Krista comes to me and says, hey, Tom, I have 10 properties. Each one of the properties is worth 100,000 and they're all paid for. I don't have any liability. That changes the structure. And the first structure, one LLC is fine. You don't need 10 LLCs. There's no reason for it. In the second structure, I would ask you, Krista, so how far away are you from retirement? What's your risk threshold? What are you looking to accomplish, right? So if you're about to retire, we better segregate all these companies because you cannot afford to lose your retirement a week before you're going into retirement. If you're 25 years old, you have a long time to rebuild, right? You're a little bit more risk, right? You can deal with a little bit more risk than somebody that's about to retire. So every single thing that has to do with your structure really has to be analyzed and looked at and giving you answers based on your situation and what you have going on.
Thank you, Tom. I think again, this is complex and complicated. So I think my last question is, if you could sit down with a business owner right now who's making about $1 million a year, but hasn't really thought strategically about business structure, credit, taxes, asset protection, where would you tell them to focus first? Like, what's the first thing you're going to tell them they need to do?
Honestly, to give us a call. That's what I would say. Call us so we can find out exactly how you're making the $1 million. Where's the source of revenue coming from? The first thing I would do is to build a team around you. Hopefully, if you're making $1 million, you've been going through and doing some research on what you need to do. Because if you're making $1 million, you're getting hurt with taxes if you don't have anything going on. And I'll say the same thing for the people that are on this podcast and are listening to this and are W-2 employees. They don't have a business and think that this isn't relatable to them. It is relatable to you as well, because even if you're a W-2 employee, we can help you in mitigating a lot of your taxes. So if you're $1 million earner, or if you make 500K a year as a W-2 employee, and you want to get into a business and you want to start an affiliate marketing business, or you want to start a real estate investing business, there are huge advantages for you incorporating your business and realizing a lot of losses and getting a ton of money back on your W-2 side. So what would I tell somebody that's making $1 million? What their next step would be is to give us a call, because they might have a corporation set up and they might be set up great financially on the tax side of things, but they might be missing the estate planning side of things. They might not have a way for them to pass on their assets to their loved ones. They might be caught up in probate, God forbid, if they pass away, and now their assets are locked up in the court and their spouse or their kids don't have access to their businesses or their assets, or they don't have a long-term solution, right, of what happens to their business in the event that something happens. And so it's very hard giving, there isn't one thing to do. There is call somebody, call an expert that really has your best interest at heart, that wants to know and find out what you have going on and wants to build a long-term relationship with you to find out what that next step is, right? Because that $1 million earner might have everything right. They might have everything right, but they might be missing a living trust. They might be missing a will. They might be missing business credit. They might be missing a tax election. So it depends on the individual, the needs of that individual, what their goals are, and what their needs are based on what would be the most important part now. You know, sometimes we talk to people and the asset protection isn't a concern. They don't care about that. Their concern is taxes because they're getting murdered. They just finished their taxes. You know, it's April. They just wrote a massive check. That's their only thing. They don't care about anything. Then we have individuals, the only thing that they care about is succession plan. You know, their mom just passed away. They had to go through probate. They had a headache. You know, they just dealt with something like that with their siblings. They don't want their kids to go through the same thing. They don't care about taxes. They don't care about asset protection. They want to make sure that they have some sort of succession plan, that if something happens to them, that it's not going to go through probate and nothing can happen. So I would say, and I know that you want an answer, Krista, but it's impossible to give that answer. The answer is to call us. You know, go on our website, go to uscorpsolutions.com, set up a free appointment, let us talk to you for 30, 40 minutes and give you the best type of information that's out there based on your situation.
Actually, I think that's the perfect answer. That's a great answer. And I think too, it's not, it's probably 9 times out of 10 not as complicated as we want to make it out in our head. It can sound very scary when we start to talk about, we took this conversation from one entity to multiple entities to understanding how to, or think how we should begin to think about taxation and all of these things. It can feel very, very complicated. But I know I've had those conversations with somebody who specializes in this area, someone such as yourself. And it is actually much, much easier once you give that information, you explain your scenario, and then you're presented with usually a very easy to understand diagram or visual that you can say, okay, this is what it looks like. Oh, and by the way, now we're also accounting for some of the really important things that you touched on, like succession, like a living trust. I think, again, we're sort of conditioned because of the way we really don't teach this anywhere. We don't teach it in school, not in high school, not in college, but we say to anybody, hey, this is the society where you can come and start a business. But we need experts speaking on these subjects because we think of them as disconnected pieces, but they're not, and they're not as difficult to connect as we think. So, Tom, thank you for coming on today and for sharing a lot of this insight with us. How can our listeners connect to you on LinkedIn, find you on social media, and then, of course, I'd love to have you repeat your website address just one more time for us.
The best way to connect with us as a group through my company, through US Corporate Solutions, is to go to our website, do a quick Google search on US Corporate Solutions LLC. You'll find us right away on Google. You'll see all of our reviews. Go to our website, which is uscorpsolutions.com. It's corpsolutions.com. On the right-hand corner, it says schedule a call. Schedule a call. It's a free call, free consultation. They'll take a half an hour, 45 minutes, an hour, as long as it takes to kind of find out what you have going on and then really give you informative information. We tell this to everybody, Krista. On this call, on any call that we have, we're not looking to make anybody an attorney. We're not trying to make them financial experts, but we do want to guide them and we want to give them the correct information so they can make an intelligent decision for their business, right? Just like me, when I call my stockbroker and I ask him about stocks, I don't need to know every single intricate detail of how things work, but I need to know what the end result's going to be and how it benefits me and what the rules are and what new things are out there for me, right? So the best way for them to do it, go on our website, schedule a call. You can always contact me. You can always search me up, Tom Nagar on LinkedIn. You'll see the company, you'll see US Corporate Solutions. Again, just set up an appointment and we'll go through that. We'll go through the process.
Well, Tom, thanks again for joining us today. All right, everybody. So you've heard it here first. So whether you are starting a business, you're already well down the road in your business, you're thinking to yourself, I need to understand how all these pieces fit together. I need to create a succession plan. I need to figure out how to tie everything I'm doing all up together in a way that is protecting my assets, balancing with a tax strategy, and also ensuring that I am protecting generational wealth. Jump out onto US Corp Solutions website, book that call, let them help you and give you some guidance on what you could potentially be missing. And until next time, everybody, thanks again for joining us.